In 2016, Warren Buffett did something nobody expected. The man who spent decades avoiding technology stocks put over $30 billion into a single tech company. Wall Street thought he had lost his mind. 8 years later, that bet turned into the most profitable investment in Berkshire Hathaway's history. What did Buffett see that everyone else missed? Welcome to Daily Investor. Today we are pulling apart one of the greatest business case studies of the last 2 decades, Apple. Not the gadget company everyone thinks they know, but the quietly fortified economic machine hiding underneath all those shiny devices. By the end of this video, you will understand exactly why Buffett called Apple probably the best business I know in the world and how a moat that barely existed in 2007 became one of the widest competitive advantages in corporate history. This is educational content, not financial advice. Always do your own research. Here is a question most investors got wrong for years. What is Apple? In 2007, when Steve Jobs walked on stage and introduced the iPhone, the answer seemed obvious. Apple was a hardware company. It sold physical devices. And hardware companies have a well-known problem: no moat. Someone can always build a cheaper phone, a thinner laptop, a better tablet. Margins get squeezed. Competitors copy your features within 18 months. This is what happened to BlackBerry, Nokia, Motorola, and dozens of others. Wall Street looked at Apple and saw the same cycle coming. In 2016, Apple stock traded at roughly 10 to 11 times earnings. For context, the S&P 500 average was around 18 times earnings. The market was pricing Apple like a commodity hardware maker with its best days behind it. That was the opportunity. Because while everyone was looking at the hardware, something else was quietly being built. Benjamin Graham, the father of value investing, taught us to look for durable competitive advantages. Warren Buffett turned that into a single question: can this business still dominate in 10 years? When Buffett analyzed Apple in 2016, he was not looking at phone specs. He was looking at behavior. Think about this. You have an iPhone. Your spouse has an iPhone. Your photos sync to iCloud. Your music is on Apple Music. You text through iMessage, which only works with other Apple users. Your kids have iPads. Your watch is an Apple Watch that only pairs with an iPhone. Your laptop is a MacBook that shares a clipboard, files, and calls with your phone seamlessly. Now imagine switching to Android. You lose your iMessage group chats. Your AirPods lose half their features. Your Apple Watch becomes useless. Your family photo library needs to be migrated. Your passwords stored in keychain need to move. Every app you bought on the App Store? Gone. This is what Buffett saw. Each device Apple sells does not just generate revenue. It raises the wall. Every additional Apple product a customer buys makes it harder and more expensive to leave. Consumer intelligence research partners found that roughly 93% of iPhone buyers already had an iPhone before. 93% retention in a market where consumers replace their phones every 2 to 3 years. That is not a hardware company. That is a toll bridge. And here is where it gets really interesting. Apple crossed 2.2 billion active devices worldwide as of early 2024. Not units sold. Active devices, being used right now. Each one is a node in the ecosystem. Each one makes the moat a little wider. Now here is the part that separates good companies from great investments. Hardware has margins of around 36%. Respectable, but not extraordinary. Services, however, run at gross margins above 70%. In fiscal year 2019, Apple's services business generated $46.3 billion in revenue. By fiscal year 2024, that number had grown to $96.2 billion. That is more than a doubling in 5 years. Think about what services include. The App Store takes a 15 to 30% commission on every transaction. iCloud storage runs on monthly subscriptions. Apple Music, Apple TV Plus, Apple Arcade, Apple News Plus, Apple Fitness Plus, all subscriptions. Apple Care is essentially an insurance product. Apple Pay takes a small fee on every tap. And then there is the deal with Google. Google pays Apple an estimated $20 billion per year just to remain the default search engine on Safari. That is almost pure profit flowing in because Apple controls the most valuable digital real estate in the world, the default screen on over 1 billion iPhones. As of early 2024, Apple reported over 1 billion paid subscriptions across its ecosystem. 1 billion recurring revenue relationships. This is the annuity stream that Buffett loves, predictable, growing, and almost impossible to disrupt because it sits on top of the hardware moat. Berkshire Hathaway began buying Apple shares in the first quarter of 2016. Over the next 2 years, Buffett built a position with a total cost basis of approximately $31.1 billion. By the end of 2023, that position was worth roughly $174 billion. From $31 billion to $174 billion. A return of more than 5 times his money. Apple was not just Berkshire's largest stock holding. At its peak, it represented nearly half of Berkshire's entire public equity portfolio. For a man who spent 50 years preaching diversification and caution, that level of concentration tells you everything about his conviction. Now, Buffett did sell a significant portion of his Apple shares in 2024. But here is the context most people miss. Even after selling hundreds of millions of shares, Apple remained one of Berkshire's largest holdings. And the sales generated enormous realized gains, building Berkshire's cash reserves to record levels. That is not a loss of faith. That is harvesting decades of compounding. Apple also became the first American company to reach a $1 trillion market cap on August 2, 2018. Then $2 trillion on August 19, 2020. Then $3 trillion in June 2023. The company that was nearly bankrupt in 1997, when Steve Jobs returned and its market cap sat around $2 to $3 billion, became the most valuable company on earth. Here is what this entire case study comes down to. The best moats are often invisible until they are unbreakable. In 2007, Apple looked like a phone company. By 2016, it had quietly built one of the deepest competitive advantages in business history. Not through patents or regulations, but through something far more powerful, habit. When your customers build their entire digital life inside your ecosystem, when switching